Welcome everyone. Sorry, we're a minute late. We had a moment of technical difficulty, but here we are. So this is the fourth webinar in our series of the wealth space, and our topic for today is superannuation. My name is Kelly Kennedy. I'm a financial advisor at BDO Private Wealth Advisors in our Sydney office. And I am joined today by Michael Ryan.
Hello everybody, I'm also a financial advisor at BDO Private Wealth. I'm based in our Brisbane office, so I'm also going to be talking with Kelly just all about superannuation. So Kelly, I'll let you take it away.
Lovely, thanks for joining us today, Michael. So I'm just changing the slide on the screen. Hopefully it'll catch up in a second. The slide seems to be stuck, but at the moment, what we should be looking at here is a picture of Quagmire, the cartoon character from the sitcom Family Guy. And I wanted to ask people, how many people attending today actually recognize this character, Quagmire? He actually has nothing to do with our session except his name. So the reason I brought him in is just to tell you about a client situation. So I had a client tell me that superannuation to them is a quagmire, and I had truly never heard superannuation referred to as that before. So I actually had to look up what quagmire meant after that. Turns out quagmire means an awkward, complex or hazardous situation, and it also means boggy or swampy land. But this client told me that superannuation to them felt like another language. And we often hear this from a lot of our clients. I personally didn't understand superannuation myself until I started working in this industry and undertook some studies. So today, the goal is to help you have a better understanding of how superannuation works, to demystify it, and help you feel a bit more confident in managing your super. Before we kick things off properly, we've got a bit of housekeeping. So the slides don't seem to be working for me, but you are all automatically muted. There is time for questions at the end. There is a question tab on the right-hand side of the screen. If you're experiencing any technical difficulties, maybe such as myself with these slides, there is a support button on the bottom tab of your screen. And also, today's session is being recorded. So all registrants afterwards will receive a follow-up email, and that will have the slides, a link to the recording, access to register for future sessions, and contact details for Michael and myself. We also need to provide you with a general advice warning. The information discussed today is general in nature. It doesn't take into account your personal circumstances, and it does not constitute legal or financial advice. All right, that's enough for the formalities. So what are we going to go through today? Firstly, what superannuation is, the types of super funds, investing your super, how to boost your super, when you can access your super, the tax within super versus other structures, and what happens to your super when you die. So we've got a lot to get through, so let's get to it. And hopefully the slides will catch up shortly. I apologise that they're not keeping up for some reason. Okay, what is superannuation? First and foremost, it's a tax structure. It's a retirement savings system. It's an investment for the future. And a good way to summarize what super is it's money that is put aside during your working life for you to live on when you retire from work. We're going to have a quick chat about the types of super funds, and there should be a table on the screen. Michael, you can't see the slides, can you?
No.
All right, so we're still stuck on today's speakers. Okay, so we'll just have to talk through until this the slides are sorted out. First, we'll start with the types. So retail funds, that's your first type of super funds. They're open to the public. They're generally, anyone can join. They're not aligned to a specific industry. They're often attached to financial advisors, and so if you want an account with them, you may have to have a financial advisor to help you manage your super investments. They offer the widest range of investment options, except for SMSF. They offer various insurance products through the fund. They are a for-profit structure. And some examples you may have heard of are Colonial First State or MLC or Netwealth. The next type is industry funds. Most people will find themselves in either a retail fund or an industry fund. Industry funds generally have an association with a specific industry, but they do also generally allow anyone to join. They will generally have a smaller number of investment options than a retail fund. They do offer insurance. It's generally a default level of cover with the option to take out additional cover. Profits remain within the fund for the benefit of members. And some examples of industry funds are Australian Super, CBUS, and HESTA. These are just a couple examples. There's quite a long range, large number of funds available. So next, the next type of super fund is corporate super funds. So this is set up by an employer for its employees. It could be either an industry fund or a retail fund, but essentially what happens is your employer negotiates so maybe special administration fees or special group insurance with a product provider, and then employees are able to take out an account with them. Group insurance is often negotiated by the employer. The number of options will depend, investment options, sorry, the number of investment options will depend on whether your employer has chosen a retail fund or an industry fund. Next, we have public sector funds. So these are generally restricted for government employees. They offer limited investment options, but they're generally low fees, and profits remain within the fund for the benefits of members. So the last type of super fund that we want to tell you about is self-managed super funds. And I'm sure some people are aware of these already. So these are private super funds that you manage yourself. You can have up to 6 members. Each member, there are requirements. So each member needs to be a trustee or a director of the corporate trustee. The members, you yourself as the member, you're responsible for the running of the fund. So with the other types of funds we talked about, say the Australian Super example, Australian Super is a trustee and they're responsible for running the fund and ensuring compliance with the super rules. With a self-managed super fund, you take on that responsibility, and you can't outsource that responsibility even if you hire professionals to help you with it. Self-managed super funds, you choose the investments. So you will have the broadest range of options available. For example, in a self-managed super fund, you can invest in direct property, whereas you can't do that with the retail funds. So I think now we're going to have a chat about just some considerations to make when comparing super funds. So I'll hand you over to Michael.
Great, thanks Kelly. And apologies again everyone that the slides aren't working. You know how technology is sometimes, but anyway, I think for most of this we won't need them. So I'm going to talk a little bit about what people need to consider when they're looking at comparing their super funds to others. And to be honest, it's not a simple thing. And you know, we do this as part of our day job. It's not always so straightforward. So I want to take you through a few considerations or a few things to look at when you are trying to compare. So the first thing I'm going to start with is just, first of all, the insurance that can be obtained inside super. So you might all be aware that there is 3 types of insurance or personal insurance you can take out in super. That's life, total and permanent disablement, and income protection. You can't really move that cover from one super fund to another. So if you take out cover in one super fund, you more or less have to stick with that or apply for new cover in a new super fund completely. So if you're looking at moving or taking out a new super fund, the insurance is an important thing to consider, because if you've already got cover in place, you might not get the same cover with the alternative super fund. And if it, even on the surface, it might look the same, but there could be reasons why they aren't. For example, with income protection, there could be completely different terms or definitions that they apply to what they consider to be disabled, or there might be different waiting periods or benefit periods. So it isn't so straightforward on that mark either. So you need to kind of make sure as much as possible that you're comparing apples with apples. And of course, the costs aren't standardized either. So you're going to have some funds with higher premiums for their insurances and others with lower, which is, makes it the whole decision on whether something's cheaper or not much more complex, because investment fees might be cheaper, but insurance costs might be much more expensive too. So that's another element to keep in mind. So you can take out cover outside of superannuation and just avoid that whole issue completely, and that's, to be honest, quite a smart thing to consider doing, because you can take out cover outside of super either direct through providers online, or you can actually go through advisors to do that. I could spend an entire webinar talking about insurance and things like that, but I won't. The important thing is that you should recognize that you can get cover automatically when you apply to some super funds, so you don't have to answer any questions. And if you did want to apply for more cover, you have to go through a series of questions that means you have to disclose your medical history, and that could result in declining cover or exclusions and that kind of thing. So there's a lot of aspects to consider when comparing the super funds from the insurance angle. The next thing is, when you're looking at whether or not it's a good fund, is performance. And that's probably the big thing that people look at, that gets reported in the media a lot. The tricky thing is that, as everyone would recognize, your past performance isn't a great indicator of future performance. In fact, I think empirically the evidence shows that there's less than a 5% correlation to past performance to future performance. So it's really hard to make a decision, even though it seems like a good idea to say, look, let's look at the best performing fund over 5 or 10 years or whatever, and make that my preferred option because that seems to be the best one. That's not necessarily going to be the case for the next 10 years. The underlying reasons behind why they're performing could be replicated, but it isn't a guarantee, of course. So it's the longer term performance that is more important to be considering, because there's going to be massive fluctuations year to year on who's doing the best. In fact, every year you're going to see who's topping the charts in the media. That changes pretty regularly. So it's not a great idea to make decisions based on those figures, particularly the ones you see reported in the media, because they're often the short-term numbers. And another big thing that it isn't always obvious is the time periods that you are looking at when comparing funds need to be the exact same end of month returns, because even a 5-year figure could be as much as 1% per annum different to another option that might only be reporting 2 months later or 2 months earlier than what you're looking at. And that's just due to what could have been big fluctuations in market movements in that short period. So just always make sure you're looking at the exact same time period. And Kelly's going to, if we had the slides working, we're going to show you a bit of historic performance data next, but she can talk through some of that to show will tell you what to expect for different types of profiles or risk levels in the industry. The next thing you should be really considering, yes, is fees. There has been a lot of work, I think, done in the industry to become more competitive. So a lot more super funds are similar now than they ever were in terms of how much they're charging. There has been a history of sort of older products that maybe started 20 years ago that people were still in, that are 4 times as expensive as the average. there we go, got some slides happening. So most people, I would say, are in probably a competitively priced super fund these days. And that's because of what's happened. There's been consolidation, super funds have merged, they've lowered their fees, but I still come across instances where clients I see have all those older products or just have selected investments themselves that have much higher investment fees. So when you're looking at the differences in fees, you need to be considering the investment costs, the admin costs, and I referred to earlier the insurance costs that could be associated there too. So I think fortunately these days most super funds are quite similar, within 0.2, 0.3% of each other. I'd say on average, as long as it's below or around 1% or below, that's fairly good. So the investment options that might be available to select from is also another consideration. I'd say that for the most part, you're going to find most super funds have a few pre-mixed options that range from very conservative to high growth, and they've got a mix of different types of assets within those options. And then of course they've also got your single sector selections too. So if you want to deliberately have a higher exposure to Australian shares or international shares, a lot of them have that as an option as well. That's pretty standard. You're also going to find some of the retail funds in particular have a lot more to show, a lot more other products to select from. And that might be useful if you're doing things yourself, you're managing the super yourself, you've got a reasonable investment mindset and knowledge. But for the most part, the general population, a lot of people don't take a lot of interest in their super. One of those pre-mixed options is most likely going to be fine for everybody. It's just a matter of selecting which pre-mixed option is the right for you at your stage in life. And Kelly's going to talk a little bit about that as well. And lastly, just super funds can offer some other features and benefits. So some will have some free advice that you can access. There will be a lot of educational material. Maybe the app itself is really nice to use. The website's really nice to use. There's a lot out there that are now doing your discounted gift cards, portals to the Good Guys commercial website and things like that might make it, if all things remain equal, investment options are good, insurance is good, fees are good, maybe you're just selected based on one of these additional features too. So that's usually all advertised on their websites, but just something else to consider if you can't make up your mind. Next, Kelly's going to talk a bit about actually investing in super and the things you need to be thinking about there.
Yeah, thank you, Michael. So superannuation, and Michael touched on some of these points already when comparing your super funds. You have the choice of how your super is invested. So most super funds will let you choose from a mix. There'll be a range of options. And so as Michael said, they might range from, say, conservative to high growth. And so I wanted to just show you this on this graph here. So the bottom line, or the horizontal, is the expected risk. And so you go from low risk, so you're conservative, and you go increasing risk as you go along. And then as you go up, so the vertical is your, I don't know what happened to the slides there. Sorry. I think we're back. So the vertical line is the potential return. So there's this relationship between risk and reward. So the more risk you take, the more you should be rewarded. But because you're taking risk, it doesn't mean you're going to be rewarded. There is that chance that the investments might perform poorly. And the higher risk you take, the more you're going to feel the ups and the downs of the market. And then, so each of your investments, each of those mix, so conservative up to high growth, they're going to have a mix underneath. So I call it under the hood. They'll have a mix of these types of investments. So a mix of cash and fixed interest, infrastructure, property, and shares. The more you have in the riskier assets, so the more shares and property compared to how much you have in fixed interest, is how you would describe your investment. So the more shares, the more risk, that would be your high growth, your growth investment options. I don't know what's happening with these slides. So I think an important point is so I'll just go back one. So just say you've got a balanced option. One provider might say balanced has a 50-50 mix. Half of it's in the riskier assets and half of it's in the more what we call defensive side or the safer side. So that's one super fund. The next super fund, they might say balanced is a 70-30 mix, so 70% sitting in the riskier assets and only 30% in the safer side. So it's really important to be aware of the underlying mix and be conscious that balance to one fund or the name of one fund might mean something different to another fund. We wanted to show you, as Michael mentioned before, the performance of some funds. So this is I took each of those risk profiles and we went to super ratings and got the top 10 super funds for each, or the top 10 super fund investment options and which super fund they're in by their risk profile. And then we took the average 5-year return from each of those. So you can see the conservative, that's the number in brackets there is the level of growth. So say 20 to 40% would be sitting in growth. And then as you go through, the high growth option would have the most level of the riskier assets. So 91 to 100% in very risky assets, or your shares, your property, your infrastructure. So you can see the difference in the returns. I think it's important to note that the mix in each of these will vary. So you can see in conservative even, you've got a range of growth between 20 and 40%. That's quite a range. So there's a chance that you're looking at a conservative fund with 40% growth earning a higher return than a conservative option with only 20% growth, which makes sense because you've got more in your growth assets. So just to give you some examples, I thought we'll show you the returns for the conservative and the high growth. So this is the conservative, top 10 conservative investment options. I think we also need to make a comment here that we're not endorsing these funds by showing you these options. And also these lists change on a regular basis. So this is just to the end of 31st August. So it's not saying these are the ones you should pick, as Michael mentioned before. Past performance doesn't really indicate future performance. So this is the conservative options, and you can see the 5-year returns. I'm trying to move to the high growth slide. Here we go. So you can see the range of returns in the top 10 according to super ratings. So quite a range of returns there. So when investing your super, it's important to think about things like the level of risk you're taking and the reward that you should be getting for that risk. It's also important to think about your time frame for investment. So a younger person may have more tolerance for risk because you've got more time ahead of you to ride out ups and downs of the markets, as opposed to someone who's closer to retirement, who might think, you know what, it's time to dial back some of that risk and preserve my capital, which is a bit more important. The options available, you might be in a smaller industry fund that has less options available to you. And then the importance of diversification. So that's another important point. We see a lot of clients with self-managed super funds who set it up with the intention of having more control over their investments, but then they only put their super in cash, term deposits, and a small portion of Australian shares. So they're not really all that diversified, and not doing anything they can't do in a retail or industry fund. Just while we're talking about investing your super, we also wanted to talk about making sure you do make a choice with your investments. So we often see clients who have no idea how their super is invested, and maybe they've gone into a fund and then just left it with the default option, and it may or may not be appropriate for them, but they haven't made the active decision around how it's invested. Sometimes when you start with an account provider, they will just, if you make no choice, there will be a default option, and it could be a balanced option, whatever that means to that fund. They also could put you in a life cycle or a life stage investment option. So that is a investment option that's based on your date of birth. And so the younger you are, the ratio of growth to defensive is higher. So you'll have more in growth, and then as your age increases, it will reduce the level of risk, which again may or may not be appropriate to you at your particular stage of life, or the level of risk that you need to take to meet your objectives, or your tolerance for risk, which I call the sleep at night factor. Generally speaking, the younger you are, the more time you've got ahead of you. So I think it can be worthwhile considering taking a higher level of risk, but you do need to do what's right for your situation. So I think Michael's now going to talk to you about ways to boost your super. Michael,
thanks, Kelly. So Kelly's just talked about different investment things to consider, and of course getting a higher return is one way to try and boost your super, but probably one of the main ways to do it for most people is to contribute. And so I'm going to talk to you now about some of the various contribution types and what they mean. So for most people, if you're employed, you're going to get a guaranteed amount. It's currently 11% of your wage guaranteed to be put in every year as an employer contribution. Now that's considered a concessional contribution because it's before tax. The other ways you can do that are by salary sacrificing, so going through your payroll to say I want to put extra in, all before tax. But you can also, and not everybody is aware that you can, but you can actually just effectively transfer money in, via simple bank transfer or a BPay into your super fund anytime, and then actually make sure that you lodge an intent that you want to claim that money as a tax deduction, and that's something you can claim as a deduction on your tax return. So that's also a before tax contribution. Often, if people, have a big taxable event in the year, such as selling a property, selling shares with large capital gains, or they just want to top up their super, and they don't know or don't have the opportunity to go through their payroll to do salary sacrificing, you can just do it yourself. You can just go and BPay the money into super, make sure that you lodge what's called a notice of intent to claim a super contribution as a deduction. It's got various names, but we call it a notice of intent form. That's critical, and you can actually then put that amount on your tax return as a deduction, and you effectively just get a nicer, bigger tax refund by doing that. So the maximum you can do of the employer, the salary sacrifice, those personal tax deductible contributions is $27,500 a year. So you have to add all those together, and you can't go over $27,500 a year. That's the current cap. That will probably increase in the next year or two. These caps are indexed with inflation, and once they get to a certain point, they will increase. So I'll talk a little bit about those concessional contributions in a moment as well, but the other side is doing contributions after tax. So you don't really get any tax benefits directly from these, but you've got a lot more to play with. So if you want to put money into super after tax, you can actually do up to $110,000 a year of those types of contributions. So that doesn't incur any tax on the way in. You don't get a tax deduction for it either. What I didn't mention with those concessional contributions is they are actually taxed at 15% when they enter the fund. But generally, you get a much bigger tax benefit from it because your personal tax rates are more than 15%. With non-concessional after-tax type contributions, there's no tax benefits to you personally, but there's no tax taken out on the way in to the super fund either. Another type of contribution that's still under that non-concessional category are spouse contributions. So I'll talk a little bit more about those in a moment. There's also downsizer contributions, which is a relatively new type introduced a few years ago now. That's only relevant where you've sold a property, and there's a few criteria to meet, and I'll talk about that in a moment. And for those who are running a business and decide to sell, there are other types of contributions available to you when you sell to actually move that money into super as well. And I'll touch on that slightly as well. Importantly, those downsizer and small business contributions, they don't count towards those caps either. I think at the next slide. Thanks.
Sorry for the delay.
So you're right. So with the spouse contributions, I find that not a lot of people take advantage of this or are aware of them. There is a specific circumstance to actually be able to use them. Importantly, it's not a huge advantage, but it's something. So if you're in a couple and one member of the couple is earning less than 40 grand a year, and that's all taxable income, then the other spouse, the one that might have the higher income, they can claim a tax deduction on their or a tax offset on their tax return if $3,000 contribution or up to $3,000 is put into the spouse's super fund, and they have to make sure that's considered and classified by the super fund as a spouse contribution. Okay, so sometimes practically the super fund will actually have a separate, BPay reference number or an account reference number to make sure that's counted as a spouse contribution, not just a generic non-concessional contribution. So in that example, say you've got a husband and wife, and say the husband's earning $150,000 a year and the wife might be earning $20,000 a year, the husband could put, or the couple could put $3,000 into the wife's super fund, and the husband is able to claim $540 as a tax deduction or tax offset. So it's a nice little boost if you're in that situation, and not everybody is aware that that's possible. The next one I want to talk about is the downsizer contributions. Okay, so these ones are being used a lot, I'm finding, and they're quite useful. The downsizer contributions are fantastic because they ignore those caps. They ignore the non-concessional cap. They ignore the total super balance cap, which is another number altogether. At 1.9 million is the total amount you're allowed to have in super before you're not allowed to contribute anything more into it. These contributions ignore that as well. So you have to be over 55 to be able to use these downsizer contributions. You don't actually have to have sold a home and downsized. Everyone thinks you actually have to have gone to a property that costs less. That's not the case. You just have to have lived at some stage in that property and owned it for 10 years. So at least, even if it's a rental property, if you lived in it at some stage, so it gets a partial capital gains tax exemption when you have lived in it, you'll be eligible for this type of contribution, and it's the total you're able to do is $300,000 per member of the couple. Okay, up to effectively the value of the property. So if you're selling a $1 million property and you say you're moving to a unit that costs $800,000, that doesn't matter. Or sorry, you might be moving to a unit that's 1.5 mil, so you're actually upsizing to a degree, I suppose. You're still eligible, even though you're not moving to a lower priced property. So you can't and it doesn't count towards the cap. So we're finding a lot of people are using this now, and it's really handy, particularly when you've maxed out everything else. Next one I'll talk about, depends what's coming up on the slide. Catch-up concessional contributions, I think. Yep.
Can you see the slide okay?
Yes, I can see it, yeah. So these are also fairly new, only brought in about 3-4 years ago. So I mentioned before, you have $27,500 a year currently that you're able to put in as concessional contributions. But a few years ago, the government introduced a measure to allow people who had balances less than 500,000 to actually make up for their unused concessional contributions from prior years. And you can actually go back as far as 5 years now. The starting year is the 2019 financial year. So this year is actually the last year you can make up for that 2019 financial year. Okay. You'll find that these are really, really useful if you've got a lot of income to be able to deduct against, because concessional contributions, as I mentioned before, they're tax deductible. So for somebody, so for an example I'm seeing at the moment is some clients who sold a large property, there's a big capital gain. They haven't put anything into super in the last 5 years. So they're able to use all of their contributions. They didn't use any of the cap for the last 5 years. Their balances are effectively nil at the moment. So they meet all the criteria. But what it means is they can each put in about $150,000 to super, and that's a tax deduction as well. So selling the big property, they're going to pay hundreds of thousands in tax on that, yet they can claim a massive amount off that tax bill because of these catch-up contributions. So it's a really handy way to both boost your super and help manage some of your tax too. So definitely keep in mind that that's something available to you if you haven't been maximizing your contributions in the past. Keep in mind, this is all stuff you can actually log in and see on your MyGov site or talk to your accountant. It's all available on the portal. So you can log in, look at your super on your MyGov via the ATO link, and you can see what your contributions were and what your catch-up concessional contribution allowances are. So you can see what you've got on there. I'd suggest you do that if you haven't already. Aside from that, I'll talk about another way to boost super very quickly. So I mentioned earlier you can do $110,000 a year of your non-concessional contributions, those after-tax contributions. You're able to bring forward 2 additional years. So you can use 3 years in one go and do $330,000 if you wanted. Now that means you can't contribute any more after-tax contributions until that 3 financial years period's up again, and then it resets and you're able to do it again. But it does allow you to quickly add a lot into super, and we often do this when there's a lot of cash that's available to put in, or you've sold something and you've got funds there to be able to put into super. So this is a really handy provision. Now, importantly, you can't put in more contributions when you start getting really close to that cap, which is about 1.9 mil. So keep in mind, if your balance is close to there, you might not be able to fully take advantage of these bring forward provisions. And you can do that up to age 75 now, but you don't have to meet a work test. You used to have to meet a work test after 67. They got rid of that recently. It's actually only in the last year or so that's allowed. So you're able to make those after-tax contributions all the way up to your 75th birthday, pretty much. And just quickly, lastly, on the small business contributions, if you sell your business or business property, and there are a long list of or a relatively long list of requirements to meet to be able to be eligible to take advantage of the small business superannuation contribution concessions. But if you do meet them, you could put up to 1.7 mil into super in one go, and it's excluded from all the other caps. So that's something else that I find is very, very useful if you're running a business and you've sold, you're selling. So keep that in mind. So the transfer balance cap is a thing that's been around for a little time now. That's in combination with the total super balance. There's all these different phrases out there, but transfer balance cap is another phrase that refers to the maximum allowed to be moved into income stream or pension phase, and that amount does index as well. But it's tricky in that it started at 1.6 mil when it came in, And for those who already had that maximum in there at 1.6 mil, you don't get the advantage of having the extra the 300,000 that the cap's now suggesting. Once you use up the cap that's currently in existence, you don't get any real benefit of the indexation that occurs in the future. So for those of you who did have 1.6 mil in pension phase, you can't add more to pension phase now. It's capped. Even though that has indexed to 1.9, that's only relevant if you haven't used all of your cap or you haven't used any of it. Okay. All right, so what I'm going to talk a bit about now is just how to go about actually accessing your super, what things you have to do to make sure you meet that criteria. So the first thing that applies is, first of all, you have to have met a preservation age. This is quickly becoming almost irrelevant because I think as of now, or 1 July this year, pretty much if you're not already 59, the preservation age for everybody is 60. Okay, if you're younger than that, you've already met your preservation age. If you're not, then it's age 60. Preservation age is just the point in time when you can start potentially accessing super. And the next slide we'll talk about some of those conditions. So you have to meet a condition of release to actually then start accessing super. Often people talk about age 65 being their retirement date and age, and that sometimes used to be because that was the age pension age. That's now 67. But age 65 is still the point where, irrespective of your work arrangements, you get full access to your super. You can pull it out tax-free generally. It doesn't matter if you're working full-time, part-time, whatever. But before you're 65, so say you're between 60 and 65, you have to meet another condition to be able to start accessing super, and that's generally around stopping work. So you either have to have decided, I'm completely retired, I'm not going back to work, and a super fund will normally make you tick a box on a withdrawal form saying that you've made that declaration. It's a bit grey in that you might decide 6 months later that you change your mind, you want to go back to work. That's still okay. You can still, you'll still have access to your super up until that point. So you don't lose access, but that's kind of critical. You have to have declared that you're retired. The other way to access super after 60, before 65, is you can still be working, but if you have left a form of employment and you're over age 60, you get access to your super up to that point. So any contributions from employment that happen after that, they're restricted, but your balance up to the date that you decide to leave an employer, and that might be switching to another job, you actually have to leave that employer. It's a form of employment. You will end up with full access to your super at that point. So often that's a way that people who are transitioning, maybe doing something different, but still want to stay in employment, can still semi-retire and have full access to this super. You can also start a transition.
Sorry, I was just going to add one point there. We also have come across clients who maybe have 2 casual jobs. They're over 60, before 65. They've got 2 casual jobs. So if you leave one of those jobs, your benefits up until that point, you will have access to those. Any new contributions that go in, you won't have access to. You'll need to leave and meet another condition of release. But that's an interesting scenario we have seen as well. Sorry, Michael.
Yeah, you're right. Yeah, so those are the main reasons people will access their super, getting to that retirement point. But there are other ways. They're limited in scope, but if you're considered terminally ill, you can get full access to your super at that point, no matter what your age. You can pull it out tax-free as well. If you're permanently disabled, so you're considered unable to do any job that you're qualified for by training, you'll get access to your super at that point as well. There can be tax implications on withdrawals under that condition. If you meet some conditions around being severely under severe financial hardship, there's some pretty strict criteria on that. You have to essentially be on some sort of Centrelink benefit for about 26 weeks before you can be eligible to do that. And then I think the maximum you can pull out is about $10,000 under that condition. Compassionate grounds is another way that I've seen in the media that some people are taking advantage of that. Being generally it's a provision to allow for people who are in very difficult situations, usually medically, but there could be other reasons. That you can write to the super fund and make a case for being able to access your super fund there. The other way that some people might be able to access their super is through a scheme that I understand not too many Australians have taken up, but it's a first home super saver scheme, or something introduced a little while ago. Effectively, it just means that you can people who haven't bought a home before can put in extra money on top of their normal employer contributions to super, and they can claim tax deductions for that. And if they put in extra, they can actually withdraw that extra amount they've put in and use that towards the property that they plan to buy. So that's something else that particularly younger people should be looking at. But to be honest, we're not seeing many people take up that scheme, unfortunately, I guess. And lastly, if people leave Australia permanently, they can actually pull their super out as well under that, and there might be some tax implications around it, but that's another condition. That's what I was covering off there. Kelly?
Lovely, thank you, Michael. Yep, so now we're going to have a bit of a chat about ways to take money out of super. We're not going to go into a lot of detail, just in the interest of time, but just a brief summary of some of the ways. Mainly lump sum withdrawals, kind of a self-explanatory name, means a withdrawal of all or some of your super in one big lump sum. You might do multiple withdrawals, but that's just, one way. Another way, so you're not forced, once you get to retirement, you're not forced to take your money out of super, so you don't have to take a big withdrawal out. You can convert your super into an income stream. We call those pensions. So one is called an account-based pension. So that's when you, I guess for an example, you are over 60 and met a condition of release. The simplest one is you're over 65. So you've got full access, you can convert your super to this full account-based pension. It's becomes a tax-free environment. There is a requirement that you need to draw down a minimum each year. It's a percentage based on your age and account balance as at 1 July each year, and that increases incrementally over time. So it starts between 60 and 64, it's 4%. And then as you get into your 90s, it gets up to 14%. So essentially the government's saying, take your money out over time. And it's the money coming out is a mixture of the earnings of your actual balance, but it could be a mixture of the earnings plus the balance itself. Then we have a transition to retirement pension. I feel like we do get asked a lot about these types of pensions a lot. So a transition to retirement, or TTR. So you might be over preservation age, but not yet met a condition of release. You could be working and want to maybe transition from full-time work to part-time work. So accessing a transition to retirement pension could be a way to supplement your income and allow you to reduce your work hours. So you've got less employment income, but you're supplementing that with your transition to retirement pension income. There are restrictions. So if you, and considerations, one is, so if you were still working, you can't have a transition to retirement pension and have employer contributions go in. Once it's in pension, no more money can go in. So if you're still working, you would want to keep two separate accounts. So you'd maybe say move 95% of your balance to a TTR, draw on your pension, and still have your employer contributions going into your normal super account. There is also a maximum, so you can't take more than 10%. So the minimum is 4% and it goes up to the maximum is 10%. So not as flexible as an account-based pension. It also doesn't have the tax benefit of an account-based pension. So essentially, a transition to retirement pension is still taxed the same way as a normal superannuation account. There are some older pensions that are around, but these are the main types that we deal with. Tax on super pension payments and the lump sum withdrawals, that all depends on the tax components, which is the buckets underneath the hood of your super fund and your age. So we won't be covering those today. But that is a good segue into the next part that we wanted to talk about, which is tax within super versus other structures. So here you can see a table, just very simplistic, showing you each of the tax structures, or the most common ones that we see clients utilize. So you've got your individual tax rates, so that's your personal marginal tax rate, up to 45% plus Medicare levy. In super, earnings are only taxed at 15%. So you can see that that is very concessional and compared to personal tax rates. And then once you move into a pension, investment earnings are taxed at 0, so very concessionally taxed. Then we move to family trust, and that really depends on the beneficiary tax rate, who your beneficiaries are and their income tax rates. So any undistributed income of a family trust is taxed at 45%, and then you distribute the income to beneficiaries, it's taxed at their personal marginal tax rate. And then you have companies, so they're taxed between 25 to 30%. So comparing the tax rate within super, it's very concessionally taxed. Then we look at the aspect of your ability to access the capital gains tax discount. So what the capital gains tax discount is, very simply, is the tax that you pay on your profits. If you've held the investment for longer than 12 months, you may or not be eligible for a discount on the tax that you pay. So the capital gains tax discount is eligible in your personal name and in the super environment. It's eligible when we look at family trusts because it's in the hands of the beneficiary, and companies are not eligible for capital gains tax discount. So when you move into pension, you'll see that in the middle box there's no ability to access the discount in the pension environment because earnings are not taxed. And then we look at the actual discount rate. So in your personal name, you get a 50% discount. And then in super, you get a third discount if you've held it longer than 12 months. So essentially, it takes that tax rate from 15% to 10%. So the comment we would make here is that overall, superannuation is a very concessionally taxed environment. So it's our preferred retirement wealth vehicle.
And just to add to that as well, I know there's I think a question about it too. There's a current proposal for extra tax to apply to super balances that are over $3 million. So that effectively says that if your balance is over 3 million, an extra 15% will be applied to the fraction of your balance on any unrealized gains included, which is the big controversial component to that proposal. But it's just applies to the fraction that's over $3 million. So it's a topical thing. Should people take money out if they have over $3 million? And of course, it's completely determined by that person's personal situation, because if you're not paying any other tax outside of super, it may be that it works out better to pull the extra balance out and invest it in your own name or in a different entity. If there are losses in an entity to make up for that might be another reason to pull money out of super. But I would say by and large, because the extra tax you will pay on any balance over $3 million is actually likely to be very, very small, you're probably still going to be better off keeping the money in super, even if you've got a balance over 3 million. But you'll need to determine that with an advisor or an accountant. But for the most part, I'd say most people are going to be better keeping it inside super.
So I think we're down to our last couple of minutes. And the last topic today we want to go through is what happens to your super when you die. So super is legally held in trust until you're eligible to access it. And when you die, your super becomes a death benefit. So super doesn't actually form part of your will unless you tell it to. So when you're deciding who you want to leave your super to, it's important to think about who you're allowed to leave it to and any potential tax consequences. So there's two sets of rules. We've got the superannuation law, which says who can be a superannuation dependent, meaning who you can pay the death benefit to. And then we have tax law, which says who's a dependent. That determines how the death benefit will be taxed. So we put this table here just to outline the difference, or there are some similarities, but the differences between the two. So a super dependent includes children of any age, and then you'll see on the tax dependent side, it's children only under 18 years of age. You'll also notice that a super dependent does not include a former spouse. So there are some slight differences in who you're allowed to leave it to. And we do see some clients, when we're reviewing their super accounts, they've got a nomination maybe to a sister or a brother or an aunt or uncle, so people they're not actually allowed to leave it to. The super fund probably has no way of really checking who this person is, and potentially they will fall under the definition of a financial dependent or an interdependent. An interdependent is someone you have a close personal relationship with. You generally live together, and one or the other, they provide financial support or emotional support to the other. So who knows, they might meet that definition, but often we find it's generally not a valid nomination. So that's something to be aware of and review for your own superannuation accounts. So death benefits can be paid to dependents either as an income stream or a lump sum. But if it's going to a non-dependent, then it can only be paid as a lump sum. So I guess if you didn't have children or a spouse that you wanted to leave your super to, the best thing to do would be make a nomination to your estate or your legal personal representative, and that way your super can be dealt with as part of your will and your estate. So the way for your super provider to actually know what your wishes are is to make a nomination. There's a few different types of nominations you can make. If you make no nomination, then the trustee of your super fund has full discretion. They decide who receives your benefits. You can make a non-binding nomination. So this is telling your super provider what your wishes are, but they're not legally bound to follow those wishes. You can actually make a binding nomination, which does make your wishes legally binding on the trustee of your super fund, as long as it's a valid nomination. Binding nominations generally expire every 3 years. So some super providers these days offer what they call a binding non-lapsing. So you just need to review it over time. It doesn't expire after the 3 years, but you should probably check it every couple of years at least, just to make sure it's still in line with your wishes. So often what we see is no nomination, and a not valid nomination, or an expired nomination. So it is important to make this part of your life admin every now and then, and review what you've got in place, and I guess making sure it's in line with your wishes and in line with your current situation. So I have seen instances where the client is in a new relationship, married to someone new, and the nomination is still to their former spouse. And then tax on super death benefits. So it's probably a complicated, more complex area. So we'll just keep it nice and brief, but essentially, tax on super death benefits depends on who received the funds, whether it's going to a dependent or a non-dependent, how they receive the funds, a lump sum or income stream, the tax components of those benefits, and then the age of the deceased and the recipient. So we're actually over time, so we won't be able to respond to any questions now, but if you have submitted any questions, we will respond directly. We'll quickly let you know we've got future webinar topics coming up. So transferring property to family, that's on the 29th of November, and then ethical and ESG investing on the 7th of February. Very quickly, we do see comments come through on ideas for topics, for example, SMSF. So if you are interested in a specific topic, please send it through. If there's enough demand, we'll put a webinar together. So thank you everybody for attending, and thank you, Michael, for co-hosting today.
Thank you.
All right, thank you everyone.
Bye.